start with understanding macroeconomics of what's going on firstly, and then we'll go straight into exactly the do's and don'ts. If we can just start off by understanding how investment decision making has changed during and post lockdown. What are you seeing, and what are some of the conversations you're having at the moment?
I think it's been a very interesting chapter in the fundraising game. I think when this whole thing started to get a bit crazy and lockdown started to happen, one of two things tended to happen for an investor, right? You either said, okay, I'm not going to be active anymore. I'm just going to see what happens, see where the dust settles, and then we can start to make some more educated decisions. Or you're looking at your existing portfolio and you're looking at a lot of them suffering and you're having to bail a few of them out of jail, right? You chuck them an extra ticket to try and see them through this time because you think they have potential. So what we found much more difficult was getting new investors active in new opportunities early doors, because it's, investment is a risk game. It's about understanding risk, taking the right risk. And no one understood what was going on, right? So unless you had an out of this world proposition, then it would be tough to get some early stage investment. Now, what did happen at the start of COVID is that there all of a sudden became hundreds of thousands, if not millions of startups that were all solving a COVID problem one way or the other. You had sort of AI on CCTV cameras that could detect clustering, and if people were hanging out in groups, or you had a coronavirus vaccine in a pill, or all kinds of different stuff, right? So for the first 2 weeks, you're like, okay, this is amazing. I've got something that's gonna really make a mark in this space. But then 2, 3, 4 weeks into it, you're still getting 10 decks a week that's solving some sort of COVID problem, and COVID fatigue started to kick in because people are like, I've just seen so many COVID decks now. It's not possible for all of them to have a shot. So I think there was an initial burst of, oh, COVID solutions, let's chuck something at it. And then it became very unsexy very quickly because people are just seeing so much. We're now starting to settle into a space where it's less about solving immediate COVID solutions, and now the solutions are about the new normal, So it's like, okay, remote working, what innovations in remote working are interesting? What have the potential to have an amazing 12 months, 18 months if we're in this space? Is it an employee benefit that benefits the whole family and not just the employee itself? Or is it a new way of communicating with remote teams? And I think that's really where the money is starting to go now that we're transitioning out. From an investor's point of view as well, a lot of them have been inactive for a significant part of the year, right? So there's actually a lot of dry powder in the scene where it's like, okay, we need to start making our money work, and we need to be finding opportunities that have real potential. I think this lends itself more to a Series A than a seed level environment. Seed is a massive risk. So, your early stage VC funds might be a better way to go and get your first 800K, first mil, something like that. Unless you find some really exciting active angels.
So if you enjoy this content, please don't forget to like, share, and subscribe. We'll be creating weekly business boardroom conversations just like this.